Welcome to Private Banking Strategies Podcast with Vance, Lowe, and Seth Hicks, your secret weapon to protect your assets and never have to start over financially again. Vance and Seth help high net worth individuals, families, business owners, and investors structure an asset-protected, tax-free fortress for their families. Learn how to keep what you earn and use the velocity of money to create your own private banking system. Join us on this journey as we explore the secret strategies of the rich and political elite and help you take total control of your financial security. Now, on to the show.
Hello and welcome to Private Banking Strategies Podcast with Vance Lowe and Seth Hicks. Vance, how are you?
I'm doing great. What do you got for us today, Seth?
We're going to discuss the applications of private banking strategies across generations. Apply various stages of life within private banking strategies in the family bank and discuss pros, benefits, and cons and various aspects that people at various stages of life are dealing with. The first one we're going to talk about is in early adulthood, let's say 20 to 35 years of age. What are some of the contexts that private banking strategies applies for the 20 to 35-year-old when they're building?
I think the reason we're coming up with this first age group starting about 20, they're in college or they're about to go out, they're about to get into their profession. And what I think has to happen, or an opportunity for that, is what is available to them at that time. Could they start their own little company coming up? Could they take higher education where they specialize in something? What is available? So in the context of what we're trying to do here is, did we do any type of banking strategy on this age group when they were newborns? Did we put a policy on them? Have we got 20 years of saved up premium, cash value, whatever for that age group? So I think that's the early adulthood for that. Other things to consider is doing life choices right now. Maybe even marriage is coming up. Maybe even family planning. And anything like that is going to come into here. So there's going to be a lot of challenges, Seth. So I think maybe we should identify those.
Sure, yeah. But I think you hit on something that was important to clarify. If a family already has the 100-year family banking plan in place and the matriarch and the patriarch, mother and father, have placed policies on children, by the time that those children are 20 or 35, their access to dry powder and capital cash value in the life insurance contract is going to be far different than someone who is starting their banking at 20 or 35. And we covered child type of policies that grow into early adulthood in the Rivera case study and in some prior podcasts. So go back, folks, and listen to those. And today we'll focus on someone, an early adult that is just starting when they're 20 years old. And so some of the financial challenges for early adulthood, I would say, maybe they don't have a lot of money. They've got limited savings. They may be in student debt from college, or their first jobs may be volatile. It may not be where they're going to land or their highest earning capacity. They may not have any financial literacy. They may come from a family where the mother and father spend all their money. So those are challenges.
Yeah, those are challenges. We have to face them. And sometimes I like to envision an opportunity for these young people to get out on a road for success. I call it the highway of success. And as long as they're on that highway and they're moving down, there may be potholes, curbs, road obstructions, or whatever else. As long as they stay on that road, they're going to get down that road. It's when life happens, a limitation happens, a challenge happens that knocks them off that road. Now they can't go forward, can't do their dreams unless they can steer themselves back up on the success highway and move forward. So we can put ourselves in this driver's seat and look at these young kids, if we're older, see kind of where we're at and what our challenges are. So the limited savings, the limited amount of literacy or cash coming in, we're just starting out. There are definitely principles, money principles that need to be enacted in these scenarios so that we don't waste our time. Our problem is when we get 35, we may be making more money, but we haven't improved our outlook. We don't have assets working for us yet. So we've got to conquer these things. We've got to identify them. We've got to have a roadmap to get all through these financial challenges to start up. Because if you can do that, in our book that Seth mentioned, we talk about doubling assets every so often. If we can start and have a foundation at that time and literally start our doubling, look how much time the rest of our life we have. And it doesn't matter how low we start. We're going to have great success if we discover and we practice and get through these challenges right here.
And one of the key examples we've discussed extensively in prior podcasts is one we titled Twin Sisters. The twin sisters were Nelson Nash's nieces who implemented small policies. One did and one didn't. One of the twin sisters used infinite banking concepts and one used a CD. And their wealth positions were completely different at the end of their lives. It's a real life example showing how it will work even with small amounts.
Oh, yeah, these small amounts, if they're put on this younger generation. Let me give you a personal example. On my oldest grandchild, when I put a policy on him, the premium was $5,000. And by the time he reached his age 25, there was almost $60,000 in this account for him to be able to use. Just there as a start. It'd have been a lot more than that had I started it when he was 1. It didn't go up equally, it goes up exponentially. So another 10 years, it'd be well over $100,000, especially if we use it and multiply it and pay ourselves back. So yeah, you're right there.
That's one of the common objections you will hear from a younger person in their 20s is, what is $5,000 going to do? When they ask that question, they don't understand compounding interest. They don't understand not being taxed on that money, that it grows and compounds tax-free. Generally, younger people make the mistake of chasing bright, shiny balls instead of implementing consistent discipline. One of the stories we like to tell is the hare and the tortoise. The hare is very capable, has all of the talent, can jump and hop, but thinks they know. The turtle doesn't have any of that talent, but just follows the discipline of putting one little foot in front of the other till he gets to the finish line and he wins the race. That's the same thing that happens in a wealth race.
We're all limited to our own world experiences and our imagination. I remember Nelson telling me, he says, you've got to release your imagination. Let me give you an example. A young person in this age group, they can figure out $5,000. If you're going to start this thing and make it meaningful and grow reasonably well, you put $5,000 in. If you save $5,000 a year over the next 4 years, you've put in $20,000 and you're going to have some interest. But in a banking strategy, as you go over that 4-year period of time, you're going to 4 times the amount of premium you put in if you're purchasing debt and you start the volume of return. You start putting that money to work. You borrow it out. You put it to work. You get payments back. You take those payments and buy more debt. Over that 4-year period of time, you're going to have received back in hand $80,000. Not 20 and some change. I can personally testify to that because that's exactly what happened to me in the first 4 years compared to the policies that I put into force. I didn't realize the magnitude of what we're trying to share with people when they put their money to work, get it back, reuse it over and over again. It doesn't matter. This $5,000, you start the process, you do it for your kids, you do it on yourselves.
And some of the benefits being able to start the compounding curve now. And procrastination is one of the biggest enemies for folks, people always thinking, never doing. And that's why if this content resonates, you should get our book that Vance mentioned called Secrets the Banks Don't Want You to Know. And that's available to you at our website, privatebankingstrategies.com. But more importantly, folks, you'll have an opportunity to access Vance's calendar through the exploratory call. And that exploratory call is where he will show you how this strategy will work for you in a step-by-step process.
These podcasts are designed to whet our imagination. Can we really do this? Am I stuck in a no-win scenario? No, you're not. America went from a fledgling nation to the most powerful nation on the planet in the first 100 years using this concept, this type of strategy. Every family, every home had great value. They got education to where they could survive and be able to benefit from these things. Another attribute of this type of strategy, the younger we start, like you said, the money is going to be there. It's going to teach the child correct money principles. If you involve them with earning something, even if it's an allowance or they get to work around the house for income, when they need something, they finance it from their policy, they pay it back. It's a good opportunity for education. It's something that we can borrow. We can work out scenarios with the young person that you pay the thing back, then there's this much opportunity for you to, immediately start financing cars or even a home or whatever else. It's a good start because that money is there in a family economy. It's private and it's available to put to work. It's not available to spend.
Did that story feel like it was about you? Do you feel like you are generating a lot of revenue but are not moving forward as fast as you would like? Do you feel you should be making more progress toward your financial goals? Do you feel stuck? Let us help you get unstuck. Are you ready to take action and get your own private bank? Please visit us at www.privatebankingstrategies.com.
Consumption that has no ROI, no return on the investment. So we start a lot of times with young folks with, do you have credit card debt? Do you have high interest loans, auto loans? Where is the debt that costs you the most in interest? And how can you capitalize your own bank and then be the banker who effectively buys that credit card debt and then receives payments from you, or buys your auto debt and then receives payments from you? And that's the best way to do it. And then that is how people start to get the discipline and the stewardship early. And it allows them to finance their future.
And that's the key, folks. That's the opportunity. That's the road of success that you're on. We just need to help our youth learn how money really works and not fall prey to what the banks have set up and become slaves to the system. We don't want to be slaves to what I call the herd mentality. We've dedicated ourselves over the last 10, 20 years just trying to get information out to people. Seth, you mentioned the twins and then financing cars. On our website, we go into detail of experience on what that impact is. How would you like to own a vehicle and have it help you transition later on in life to income from money that you have working for you instead of, depleting retirement base or something? So I think that's the drive that we have, is to get this information out, get everybody an opportunity. Does that mean that if I'm 60 years old, I've missed the boat?
No, not at all. The compounding curve works best when you start now, because that compounding doubles at the end of your life. When you're 60, you may or may not have a 30-year curve of compounding. If you live to be 90, you can still implement these banking principles and bequeath them to your children and grandchildren so that they maintain the financial stewardship and discipline principles that you start. So there is no too late to start. It's just a matter of how you would apply it.
So on this age group, we're still on the age group, this first starting age group. And the next topic here that we've got to hit is, what should the premiums be?
I think it will depend on a person's circumstances. If you're 20 years old in school and got 2 jobs to put yourself through school, your policy start will be different than someone who they worked from the time they were 14 to 20 and they built up savings of $50,000. Those 2 places you may start differently, but I would say the minimum would probably be $5,000 for that early side start. But that doesn't mean that's the right place for the other person that I described.
Folks, in this age group, $10,000, $25,000 annual premiums, I want to clarify that, It is capitalization. Instead of a cost, we're capitalizing. We're a strategy. We're investing in a strategy. We're starting to put money to work on a regular basis. And so we're moving money into this thing. Does this have to come out of pocket? We show people how to set up a system and use money that they're giving away to fund the premiums so that after year one, no more money comes out of pocket, period. Nelson Nash, this is where I'm trying to get to. It scared me to death. I did my first meeting with high-end clients, had 72 clients in an office, and he taught his book over a 2-day period of time. And one of my clients asked, well, how much premium should I put into this thing? I love this. Nelson Ness, well, I can answer that if you'll answer a question for me. He said, how much do you make annually? And the guy looks at him in a room full of people. He doesn't want to say his annual income. He says, no, I'm trying to figure out how much premium. He says, I'm trying to tell you, you want to put as much as you're making into your own bank instead of someone else's, because right now you're putting 100% in someone else's bank, right? Yeah, get there as fast as you can. Just start where you're comfortable and get there as fast as you can. And that's what we've all done. All of our successful clients, we started low, maybe wish we would have started a little bit higher, but that's just a learning factor. It doesn't matter. You start and you move money that you can under a plan and under a strategy so that you know where it's coming from, what it's going to be doing month by month.
And that's what the 8-year analysis does for you folks. You can take a test drive with Vance, and his calendar is available to you when you sign up on our website and get the book. And so that opportunity is made available to everyone who resonates with this content. So check our website out, folks, at privatebankingstrategies.com. If you like this content and subscribe, we have a small niche, and people that have access to us are few. And so we think you should take advantage of that at this time. We're not trying to reach the masses. We're trying to help red-blooded folks and normal Americans take back the banking equation in their life and secure their families' futures. Vance, any closing remarks?
No, we've got a lot to talk about, folks. So I hope this has intrigued you a little bit. We want you to stay tuned because we've got a lot more coming your way. Thank you very much.
Thanks for joining us, folks. Hope to see you on the next one.
Did that story feel like it was about you? Do you feel you should be making more progress toward your financial goals? Do you feel stuck? Let us help you get unstuck. Are you ready to take action and get your own private bank? Please visit us at www.privatebankingstrategies.com.
Thank you for listening to the Private Banking Strategies podcast. Click the subscribe button below to be notified when new episodes become available.